I'm still who I am and still kind of set in my ways, but I think the gracious credit that my wife is giving me for, there is definitely more of a dialogue than there used to be. It used to be, we don't talk about it. I was afraid to talk about it. If we kind of moved into it, it kind of went into a tense moment, and never really got too far.
I'm so very proud of where you guys are. And I know we still, have more to go because, you just said you want to buy another house and we want to do this and that, the goals get bigger and bigger and bigger. I love it. I love it. But you're just getting to the point that anything that people want is possible with the right plan. You just got to plan and execute. That's really the bottom line. They have. Well, what's up, everybody? Thank you for joining me again for another wonderful podcast episode. Today, we are talking with Andrew and Jennifer, and y'all can say hi, guys. They are a part of the Integrity Financial family, and I asked them if they would join me today to come and hang out so we could just talk a little bit about their financial journey and some of the challenges that they've had along the way and some of the wonderful things that they've been able to accomplish. And I'm just so proud of them. I'm like feel like I'm the proud parent, if you will. And so I just want to dig into that a little bit today and just allow you an opportunity to share some things. So we've been working together since 2021. So it's been a good little minute, since February of 2021. So now it's been a couple of years, and we don't meet on a regular basis now. We kind of meet quarterly. In fact, we had kind of stopped meeting for a while. Everything was going pretty well. And then, as life would have it, sometimes you have some things come up and, you're like, hey, I think we need to come back and see you again. And, that happens commonly sometimes with our clients that, life happens and you're trying to navigate the new life stuff and trying to figure stuff out. So going back to the beginning of when we first started in February, how would you describe where you guys were financially and how you felt about your finances at the time, and anything you want to say pertaining to that time period? Either one of you can go first.
I think there was a lot of anxiety. It just felt like we were constantly in debt. There was a lot of home repairs that needed to be done. And anytime we would get some money, we would just not know what to do with it, and it would end up just being spent. So I think it was just a lot of anxiety and stress on our marriage because we weren't working together on the finances. And so I think that's probably where we were at that point.
Yeah.
I think that if I remember right, I think the event that kind of led to Jennifer reaching out and finding you was a ballet intensive that our daughter was going to be going to in the summer, and coming to the realization that we really didn't have the money, we didn't really have a financial plan to kind of get there, was kind of like a big impetus that kind of realized, okay, let's get some professional help and kind of help sort this out.
Gotcha. And Jennifer, you hit on some really key points there about feeling anxiety around money. I mean, I think there are a lot of people who kind of go through that point, or who are probably going through that point right now of feeling some level of anxiety. What do you think caused you to feel that way, feel anxiety around money?
Just that, like, we had an extra, I guess it was like a easy loan, and just in case, we had gone over, we could just borrow from that every now and then, and it was completely full and there was nothing else to bother or borrow. And so we were putting stuff on credit cards, and it just became I just kind of felt sick to my stomach thinking in debt, we're in debt, and we keep getting more and more in debt.
Gotcha. What was, for both of you, what was it like growing up as far as money? Like, did your parents teach you any money principles at home growing up, or what has been your experience with that?
So for me, I was always, money was never talked about. It was always there. And as I grew older, the constant message from my family was, you don't worry about money, it will always be there. And I kind of knew that my dad would get a bonus every year that would cover all of the debt my parents had gotten into throughout the year.
Mm-hmm.
And then he just continued to move up in his career, so money was always there.
Mm-hmm.
So that was kind of the attitude, that was the message that was sent to me, was you just don't worry about it. It'll be there.
Mm-hmm. Mm-hmm. Gotcha. What about for you, Andrew?
Yeah, I think in my case, circumstances were a bit different, but kind of led to maybe a similar result. So like in my case, I guess from like a socioeconomic standpoint, the fact that I'm where I am today is, kind of like a minor miracle.
Mm-hmm.
Um, but kind of where I started out, family was very, pretty much on the poor side. Couldn't afford to like wanted to go into Boy Scouts, but anything pretty much at all beyond the bare necessities was just not within our domain. I learned a little bit of financial management just on my own from having a paper route, and I could buy clothes with what that paper route allowed, and that was pretty
Mm-hmm.
much about it. So a little bit there, but it never, the whole financial planning and the greater complexities, there was no exposure to that at all. So it might be kind of a parallel with Jennifer. So yeah, really, other than how to manage a couple $100, that's pretty much kind of where it ended.
Mm-hmm. Mm-hmm. Do you think that what would you say, Andrew, is the role that the fact that you grew up the way you did, as far as the family maybe not having as much money and that type of thing, how has that impacted you now as an adult? Before we started working together, how did that impact
Mhm.
you financially, and how you were carrying yourself, in the household, with how you felt about how money should be handled?
Yeah, that's a good question. So in a way, I guess the overarching thing, I would say it stunted my ability to really look at this from like a holistic perspective. I kind of felt like we were always broke. I kind of felt like I didn't really have any money to buy anything for myself per se. But I didn't really have any kind of, organized way of moving forward from that. So it was kind of like a very stunted perspective, I guess. And I
Mm-hmm.
just, I trust my wife completely, so I trusted her to manage the finances. But that I took that too far, like not engaging at all, I think led a
Mm-hmm.
lot to the anxiety and me being so detached, thinking that it was just a matter of trust. It wasn't helping things. So I guess I didn't really know how to engage in a sort of organized, sort of smart manner about
Mm-hmm.
finances.
Mm-hmm. Well, that's really good, and I'm really glad you said that, because a lot of couples struggle in that area. Like in your case, you were like, "Okay, my wife can handle it. It's good." Some couples haven't even gotten that far, as far as just being able to bring the money together. That's already a challenge from day one, that they don't start out with the finances together. So in your case, the finances were together, but you're saying, "Hey, you kind of overtrusted, not in a way that she wasn't going to do the right thing, but in a way of, we need to do this together. We still need to make some financial decisions together." And I think that's important to point out, for couples to really consider and think about, that just because one person is managing the money, meaning they're executing the plan, but as far as the overall decisions, the decisions are still that of the couple, of the unit, to sit down and say, "Hey, this is what we have planned. This is what we're going to work on for this month. This is what the budget looks like for the numbers. Is there anything that you have going on that we need to account for? Anything I have going on that we need to account for?" And making sure that everyone's needs are accounted for. Because when you're not communicating that, then that's how stuff gets missed. And then it's like, "Oh, well, I just spent 300 out of the account because I needed to do such and such. But if you're detached, then that's not going to be a big deal to you, because you just figure your spouse will take care of it, when really that's just lack of communication, because now it's throwing the whole budget off. So I appreciate you sharing that, is my point, because I wanted people to really understand, especially married couples, some of the challenges that come up with trying to be able to work together with the money. Yes, the trust is great and all, but you still have to be engaged, even if one person is managing the money. And that's typically how it is in most couples anyway, is that one person is usually better at just the execution of, I'm going to pay the bills, pay this bill, that bill, the responsibility of the admin portion of the budget. But togetherness is definitely going to get you way further ahead, as you guys have been able to see over this time period, that we've been able to work together. So anyway, thank you for sharing that. So in the beginning, now, I would say that my assessment of where you all were at the time in terms of how you approach things was a little different than the average couple I see, because you guys had the right idea as far as, we don't want to have a mortgage forever. So you had a 15-year mortgage. You went really aggressive, like, hey, we're not going to do it 30-year. We're going to do this at 15, and we're going to pay it off as soon as we can. So, y'all had the right idea. We got 10 years left on our home. And, you are very aggressive on retirement. So, that was a really important thing. But the issue was, and you didn't have like an overabundant amount of debt. It's just that the organization of your debt. And just to be clear, you guys are a 6-figure family earners. So, it's just a matter of changing. It was a matter of changing around the organization of the funds, because sometimes, so this is one of the things that for you guys that are listening and watching, that I really want you to get and understand, is that a lot of times people will make really good money, but they're just trying to figure out, how do I allocate in the right way to get all these things done? There's so many things I got to pay for. I got to pay for the kids. I got to pay for healthcare. I got to pay for my car, my insurance. I've got to pay for the house. And, how am I supposed to appropriate the money to all of these areas in a way that's going to serve me well? And so sometimes, consequently, you'll have people that will have too much money going into retirement. Maybe 50% of the check hypothetically is going into retirement, and another 20 over here, and the percentages are just like all out of place. And so that's kind of what was happening with you guys, is that you had you were being very aggressive on the mortgage, which is not a bad thing, but it wasn't serving you well, because it was strapping your cash between that and the tuition with the kids, and then having so much money going into retirement. It just kind of really made things tight for you to be able to save the way you wanted to, to handle your day-to-day stuff, which then caused you to have to get the side loan, if you will, and lean on the credit card and this and that. So I just wanted to point out that the situation was a little bit different, because a lot of times clients are coming in with a lot of debt. They'll make good money and they have a whole abundance of debt, 6, 7, 8 credit cards. That was not y'all's case. You actually are pretty conservative. So both of them, just to kind of point out, y'all have 2 cars at the time anyway, when we started, a 2012 and a 2014 car, and here we are in 2023. So that already speaks to your level of conservativeness. Like, you're not like just going out and blowing money on, let me have a Corvette. You were trying to shift and move money into what you felt like is the appropriate way. But we just needed to, like I said, just kind of readjust the numbers so that you can still have a great retirement. So right there, I know I just said a lot and I didn't really give you guys a chance to comment, but I am going to have to take a little quick break. So we will be right back. And we're back. If you're just tuning in, we are talking with a couple of our Integrity Financial Family clients, Jennifer and Andrew, and we're just kind of talking at the beginning of their journey, a little bit of kind of where they were when we first started this process a couple of years ago, what their mindset was around money at the time, what their upbringing was, anything that they may have learned about money and that type of thing. And I was, just before we went to break, I was talking about how conservative they are, how that's in some particular cases, I was saying that they make good money, but the way that their money had been allocated, they were being very, very aggressive in retirement. And, they had the 15-year mortgage, which, in some regards is a good thing, because you don't want to have it but for so long and pay all the interest. But at the same time, it was really cramping their cash flow, because they also had tuition to pay and different things, activities and whatnot, as far as their kids were concerned. But I was saying on the flip side that they were not heavy spenders from the standpoint of they weren't out doing lavish things. So, I was saying that they're driving 2012 and 2014 vehicles at the time, which we're talking about, a 10-year-old car and at that time, a 7-year-old car. So, that's, pretty commendable, because that's probably not the average person today. There's a lot of people that are still doing that, but that's not the average, So, so definitely kudos to you in that area. But I just wanted people to have kind of a context to understand, kind of where you are, so they can really appreciate when we get to where you are currently. So now I know one of the hard areas for you, Jennifer, was about the groceries. I know we spent some months trying to kind of get that together, so to speak. It was a difficult, because y'all are a family of 4. Well, okay, 4 plus pet. So and so trying to navigate, trying to bring that grocery bill down. What would you say in the beginning, like that experience was like? Because I know we had a lot of conversations about that.
Yeah, I think the biggest problem was just thinking about groceries this is your number, and once you hit that number, that's it. So you have to decide, do we really need that this week? And maybe it can wait until next week. It's still a challenge, but I definitely think that I constantly am always knowing the number whenever I go in. And it just helps with making a decision of, well, we don't need to get that here. I know I can get it for $5 cheaper over there, or, maybe next week we'll get that. And then I think also, and Andrew and I kind of always went back and forth, that he would put stuff on just to keep stocking up. And I would just say, we don't need that right now. We can wait another week before that one goes on the list. So it was just completely changing the whole mindset of, when you go shopping, this is what you have, almost as if it would be better to have cash. And when it's gone, it's gone.
Right.
And that's, we're going to have to eat.
And I'm sure I did in the beginning, challenge you guys to take out cash. I don't remember if you did or didn't, or how that went exactly.
Yeah, we never actually did the cash, just because we had a really great grocery credit card where you could get 6% back.
Okay, I do remember that.
And it was very easy to monitor how much was being spent on the groceries, because we were just using that for groceries.
Right. Gotcha. Okay. Yep. That's good. So I'm going back to your 2-month homework, in which you had to look and see how much you were spending over that 2-month period. And your groceries for 1 month at that time was $1,709, $1,709. That's pretty up there. Now, in Jennifer's defense, now she does shop at like Trader Joe's, Mom's, she's at the organic stores. So that, of course, is definitely going to make the bill a little bit higher. But we're still talking about a family of 4. So I did still challenge her, like, all right, we got to bring this number down a little bit. What can we do? What are you guys willing to do? That type of thing. And so I see here, when we first kind of got going on your first official month's new budget, that we made the budget. It was looks like the budget was $800, I believe, for the month. I think we cut it down almost half.
Right.
Yeah, something like that, which I know that was definitely a little challenging.
Yeah.
It's definitely been a work in progress. So I do see, currently, you're not quite spending $1,700 like you once upon a time. So you definitely have kind of brought that number down some. Would you agree?
Oh yeah. I think definitely groceries have gone up, and I know we've kind of raised that budget from, I think it was $200 a week to now it's $300 a week. And I would say probably about 4 out of 6 weeks I can keep it in that 300. But there are some weeks that it goes over, just depending on what it is that
right.
Needed. So
gotcha. Well, it was definitely more detrimental, obviously in the beginning when we first started doing this, because there were other things that we were trying to capture. For example, savings. In the beginning when we first started this process, their savings was a nice big fat 0. So, which, for some people it's easy to judge and say, what, you didn't have any money in savings and you make 6 figures? Please, there are so many people in that boat that nobody has room to judge anybody else about where they are or are not, with their savings, because it's a real thing. And I'm sure that as people are listening or watching this YouTube or podcast, that there are many people that can relate and understand, like, okay, yeah, I'm doing something wrong because I know I should have more money to show for what I'm making than I do, and I don't, and I need to fix it. So, it's nice to be able to hear from someone who started out at that place as well, that, we were trying to, we had a 15-year mortgage. We're trying to, we're going to be able to retire well, but we don't have any money saved. So every time you had an emergency, what was the process? Did you do it? Did it like wait till the next pay period, or like, how did you handle emergencies?
Usually, I would, not pay a bill.
Mm-hmm.
It's postponed. I mean, I always pay the mortgage on time, but I would go a month or two without paying an electric bill.
Mm-hmm.
And then I would pay it, they'll we'll have a little bit more money in this month. It's a month that Andrew gets an extra paycheck, or I'd put it on a credit card, or we would just pull from the line of credit. There was never, I never had this feeling of like, oh my gosh. Well, I should say I had this feeling that if we ever had an emergency, really, that would cost thousands and thousands of dollars, I just didn't know what we would do. I thought, oh my gosh, what are we going to do? I mean, I guess we could withdraw from one of our retirements and do something like that. That's always where the anxiety came.
Got you. Now, you just brought up a good point, because I do meet a lot of people who have used their retirement account as their emergency fund. And I just want to clarify, not for y'all, because y'all already know, but for the benefit of people listening who still need to change some things financially, your retirement account is exactly what it says, a retirement account. It is not an emergency savings. But I get so many people that are like, oh, well, yeah, I borrowed from my TSP to do a down payment for my house. Oh, I borrowed from my TSP so I could pay off some bills. What? And then sometimes they'll take it a step further, and they're upset with the government for penalizing them for pulling money out of their TSP or out of their 403B or out of their whatever, because they're getting penalized at 10% because they're under age 59 and a half. Well, that was put there on purpose to be a deterrent to protect people from themselves. It's there because you weren't supposed to touch it before age 59 and a half for that to even be a problem. You know what I mean? So, but so many couples don't really understand the importance of saving money, because the emergencies don't give us a heads up. We don't get any advance notice that, the AC is going to go out and you're going to need $8,000 tomorrow, And so in most cases, people end up either financing through the air conditioning company, or they're going to the credit card, or they'll get some other outside loan. Either way, all of those options are not the best option, because these are known things. If we decide to buy a house, we know at some point, especially if the house is older, we know that at some point in time, the AC is going to need to be replaced. You're going to need a new refrigerator. You're going to need a new stove. These are known things that we honestly just don't think enough about. We're not intentional about the fact that at some point these are going to break. And when they do, how are we going to pay for it? Now, some people get the home warranty, and I'm not entirely opposed, but that's a whole different discussion that would for another day. But even still, the home warranty company doesn't cover everything. You know what I mean? And so, did you guys have one? I don't remember.
No.
Okay. Right. Okay. Got you. Well, now you have money. So I love it. I love it. Yes. We have money now. They didn't say it, but I'm saying it for them. We can pay for repairs now. Thank you. So it's a really, really good feeling. So, so anyway, kind of moving forward. So when we looked at your, personal allowance, let me see. No, before we even get to that, you also had at the time under your miscellaneous at the time was like $1,700 for the month. And some of that was warranted, like co-pays for doctors and things of that nature. But the rest of it was just kind of miscellaneous stuff. And then there was another column under habits with another $595. So even though y'all didn't have a lot of debt, there was still money being spent on just, stuff that comes up with the kids or with yourself or activities, or just seems like, just a whole lot of things at that time.
Yep.
And so how hard was it or easy was it when I said, okay, now we got to come up with an allowance, and like you got to stay within this number. And in this case, y'all went really drastic with it. We dropped down to $100, looks like 200, 100 a week, basically. It looks like something like
Yeah.
that each.
Yes.
100, which is, that's a pretty low number when you look at, if you're making a 6-figure income, $100 a week out of your paycheck is not a lot of money. And so that was a big drop from what you're used to spending. So do you recall how easy or hard that was to try to make that transition?
It was really hard.
Thank you for keeping it real.
I mean, I think what helped was just writing everything down and seeing it, and then and then being able to write the lines down of, okay, this is what we have to budget for every month, and we know we need this much for that, and we need this much for that, and then, okay, well, there's a little bit left over. I want to get my hair done. That's almost 2/3 of that $100 that week. So
right.
And then, it was stressful trying to get it down. But I think, and I don't think we needed to have it so low, but I think that having it so low just totally changed how I thought about everything. And to this day, every month it's like, okay, if I go over, where did I go over, and can we change it next month so that we're prepared for when this happens?
Right.
Because we know it's going to happen. And then having done it for now 2 years, I know September is here. I know there's going to be more school expenses than there would be in another month. And I know in October, soccer expenses will pick up. So just every month, it's so much easier to just say, okay, yes, we know this is coming, and we can plan for that. And that's what we're going to need. And then we're able to take our personal budget up a little bit, which is nice, because then it's not that I'm not that worried. Okay, well, we just spent that, but we have, that's how much we've budgeted for. So
right. You planned for that.
Yeah.
And I just have to point out too, because I know that, as I say out loud to people listening and watching, that, that y'all had a $100 personal allowance for the week. Some people are like, what? Oh no, I'm not doing that. I'm not doing. I will never pick up the phone to call her number. Let me just clarify. I just want to clarify that when I am working with couples, myself or anyone from my team, we do ask the couples. Not everybody is automatically on $50 or 100 or 200 or whatever. A lot of it is largely based on what goals they have in relation to where they are with their money at the time. If we've got a boatload of debt, we're going off of how much money is left over at the end of the month, how much excess cash they have to be able to attack debt, or to be able to save, or to be able to put into retirement or whatever. So we typically will leave it up to the client. Now, I'm always thinking of a number, but typically we will say, hey, Jennifer and Andrew, okay, you got this much money left. How much money do you want to allocate for personal allowance? And usually, because they know that they're in this process and they're going to have to do things differently, the couples come up with their own numbers. So this is not me being the warden necessarily saying, yeah, you're going to do $100. You know what I mean? So I just want to make sure that I make that clear, because I know that I'm probably sticker shocking some people, with hearing $100 a week when they're used to spending $300, $400, $500 or whatever.
Yeah. And Breanna, if I could chime in just a wee bit on that. Well, you definitely let us know that we were kind of, lowballing it per se, going low, and that, there was definitely no influence on your part in terms of the amount that we settled on. And then one thing I wanted to touch on at some point. So one of the things with our family values, our daughter is in a very expensive pursuit in terms of ballet, and that's very expensive. And a family value of ours has been giving our kids opportunities, like in my case, I certainly never had. And you have never tried to sway. You assessed where we were coming from, and you advised us from there. You never tried to change what we put into ballet. You're like, okay, I understand this family cares about this. Okay, well, how can we move forward with that as a core value? So yeah, so I mean, your guiding principles have always been there, but they haven't tried to tell us what to do per se. It's always been finding a path forward with what our values are.
Awesome. Thank you for sharing that. So Jennifer, you also brought up a good point about planning for the knowns. So I did want to just take a minute and talk about that for a second, because you were talking about how now for September, August, or whatever, how to plan ahead so you're not caught off guard as if you didn't know that school was coming, or that karate was coming, or ballet, or whatever it is that normally would creep up from a financial standpoint. Because before, typically it's not that we don't know it's coming, it's just that we're not planning like that's really what it is. So when we see that it's I often give the example of birthdays. We parents are sometimes the worst when it comes to birthdays. We know that every May that birthday is coming, but a lot of times parents will wait until June, and till April or right at May, and then they decide, oh yeah, I want to have a party for Johnny. Johnny's turning 2, and I need to spend $500 on this party. But you knew this all year, and so sometimes they'll do whatever sacrifice they have to make because they want to make this party happen, for their child. So it's really important that we plan and think through all the things that we know are going to happen for the year. But a lot of that comes from the paycheck to paycheck mentality.
Yeah.
That's really the truth of the matter. That's really the root issue. Is we have become so conditioned to living paycheck to paycheck. And oh yeah, I have 2,000. I get paid next week. I get paid in 2 weeks. That's how we think. But we have to think a lot differently. And I know I just talked to you guys about that this week, about thinking differently than just opening your mind to expand beyond just right now, what's in front of me in the next week. So let's see. So you guys have progressed tremendously, as you should, given the time period that we've been working together. And I know you had some transition in between. You had some home improvements in between. And we were able to grow your savings account in this time period. We got you kind of used to adding money to savings on a regular basis, making that a priority. Because and then we also, when we looked at retirement, I know we determined that, Andrew, you were being almost too aggressive. Not that there's such a thing as having too much money at retirement. Nobody will ever complain, I have too much money. But it really was just that you could afford to pull back based on our projections. We saw that you would have way more. I think it was even higher than what you make now, as far as what the projection showed. So we were able to pull back from the retirement in order to allow you to get ahead on the savings and some of the other goals. So how was that process for you, as far as like was it hard for you kind of accepting that as an option to get you ahead when you're so used to, I got to put this money in retirement? Was that difficult for you?
Yeah, for me, I think I think it was challenging, because I think I really, for better or worse, and part of it comes from what I kind of call that paper route mentality, which is kind of that financial management mentality that I had as a kid and never really took it, to any higher level. But when I first started working, I put what at the time was the maximum you could put, which was I think 10%. And I said, okay, I'm going to work for a long time, so let me do 10% high risk and just leave it there. And that just kind of kept going. And I think we even increased it a wee bit.
Yeah, it was up to 12.5%.
Yeah, it was up to 12.5.
Came to you.
Yeah. By the time we came to you, the rules changed a little bit. But anyway, I really approached it again, sort of from an infantile standpoint of, well, I've always been putting this much in. I have to. I just have to. And one of the things that, in a number of different ways, I would say that working with you was really helped, is kind of to help me sort of, get out of that kind of mentality and helped to kind of see it from a different perspective. So I think it was hard, but I think the way you went about it, helping me to kind of see the numbers, kind of breaking it down till I could see it, on the screen, that really helped. It was the kind of thing where, I mean, my wife and I, we tried before we met you to have different financial discussions, and they never went well. I think emotion kind of got into play. And if, from my perspective, if I've got that paper route mentality and I'm trying to make a major decision, it's just not really working. So I think that it was a challenge, but I think the way you went about it and the process that, the overtime process that went, it definitely helped me to get to a place where I never thought I would have gotten to before.
Awesome. That is wonderful. Yeah, I mean, and sometimes it's definitely difficult when you're used to doing things a certain way. You kind of, especially the older we get, we can get set in our ways very easily. This is comfortable. And the idea of change, can definitely be difficult. But I think being able to see kind of, well, if I do this, what are the rewards? Where is this going to take us? What's the goals here? What are we going to look like 6 months from now, a year from now? And a lot of the changes that we made were temporary. We did some temporary things in order to really boost up building up the savings. Because I don't remember exactly, maybe y'all remember, but by the end of the first year, you had like at least 16,000 or something like that. I know you had you had grown it a good amount.
Yeah. So I think so we pulled back on his retirement around July, I think, of 21, and all of that money went right into savings. And so I think by May of 22, we were able to know that we had to move. So we were able to know that we could put $40,000 into fixing the house. And after we sold and bought the new house, we, at that point, I think by July of 22, and that's including all the moving expenses we had to check out and everything, I think we were up near 85,000.
But I mean, as far as like what you saved on your own before you moved, how far did you get with that?
So that was about, we were saving about 1,000 a month at that point. Okay. So we would have been around probably about 10,000.
Within what, 6 months or within the year?
Within about 8
months. Yeah. Okay.
Yeah.
Which was huge, considering that you weren't used to putting aside, so Jennifer, being the person that's managing the money, how difficult was that for you to go from, spending the way you were used to moving money around to saying, oh gosh, I got to put $1,000 in savings all at one time?
I mean, it wasn't that hard because I knew exactly what the number was that was coming, the additional number that was coming from his paycheck. Okay. And that was not in the budget sheet, right? Okay. So that just went over to the other account. It was like I never had it.
Okay, gotcha.
And that for someone like me, that was much better.
Gotcha.
Well, where I couldn't see it. So
right. Out of sight, out of mind. Well, you just brought up another good point though about money that you don't see. So a lot of times people will get raises and or bonuses, and generally speaking, the natural tendency when people get raises is, oh, I'm going to have another $200 coming in, per pay period. So now we'll be able to do this, that, the other, or we're going to pay off bills or whatever the case may be. So for those that are watching or listening and you have struggled in the area of being able to save money, that is an easy way to get started. If you know that you have a raise coming up or you have a bonus, instead of saying, I'm going to take this bonus money and pay off bills, or I'm going to use it for vacation, or I'm going to just go shopping, or instead of taking that raise and, spending it and allowing it to become a part of your routine, act like that raise doesn't exist. If the raise is $200 more per pay period, go ahead and redirect that $200 into a separate online high yield savings account and allow that to be your starting point so that you can start building up a savings account. If you've had difficulty in that area because, you move money and then it's in the same bank with your checking. So you log in and you can see that you have money, and then you're moving money back from savings to checking. A lot of people fall into that trap all the time. They put money in savings, they move it back. They put it in, they move it back. So if you're someone who has that level of trouble of, touching it and moving it and all of that, put it away from you, out of your eyesight. But you could do the same thing if you got a bonus, like I said. So anyway, I want to thank you for bringing that up, because I really wanted to make sure that people really think about that. That's a really, really big deal. So, and with that, I'm going to pause and take one more break, and then we'll come back and wrap things up. We'll be right back. And we're back. If you're just tuning in, we are doing another episode about money. And we're talking to Andrew and Jennifer about their financial journey that they've had with us as part of the Integrity Financial family. And if you've missed the first half of our discussion, you'll definitely want to go back and catch up, because it's really been some great dialogue, especially things that go on between married couples when you're trying to navigate money, which we know that finances is one of the top causes of divorce. So if you can get on the same page about money, like, you're already a winner, when it comes to that, as far as marriage. So I want to kind of, I did have one question. So now, knowing where you are now, do you feel, how has this change affected you from a marriage standpoint? Like, were y'all arguing more then? Are you arguing less now? Like, what's different now that you're in this place?
I think it's probably a lot less frustration on my end. It still took a lot of work to get where we are today, as far as how we talk about money.
Mm-hmm.
And I think, just being able to understand, like, what our retirement situation is, and that is not something that we need to be worrying about right now. And then anytime I say, we're going to spend money on this, I don't get this, we can't afford that anymore. It's more of, okay, and then he'll ask me, have we budgeted enough for us to get the car done and spend $700 or something? So there's a lot less frustration. There's no more being told we can't afford it. There's no more just going and spending $1,800 on getting the car fixed without consulting me and seeing if that we can afford that this month, or could we hold off until we budget some more for the next month. And then he usually will check in and say, how much do I have left on my personal budget this month? Because I want to get this. So there's definitely a lot more communication, which helps the overall process, and a lot less frustration.
Is there anything you want to add, Andrew?
Sure. So I remember before we met you, I remember having a heated discussion with my wife over dealing with like finances and trying to fix our house up. We were already thinking then, like, we may not live in the house we were in at the time, forever, that and we knew that it needed to be fixed. And there was kind of a heated discussion that kind of ended with, like, me feeling, not saying it was true, but feeling like we didn't even have the money to, like, get a can of paint to, like, help something. So, like, a major repair was just way beyond our capacity. And I think that was probably one of the conversations that not too long afterwards led us to you. So where we are now, so I mean, I'm still who I am, and still kind of set in my ways, but I think the gracious credit that my wife is giving me for, there is definitely more of a dialogue than there used to be. It used to be, we don't talk about it. I was afraid to talk about it. If we kind of moved into it, it kind of went into a tense moment, and never really got too far. And I feel like there's definitely, more dialogue now, and we make plans for, doing things like with the house and such, car maintenance, like Jennifer talked about. I never thought of budgeting for car maintenance before. So I'd say we've definitely come a very long way, and you've definitely opened up a door for us to allow us to move forward together on these things, as opposed to just sort of ignoring them and hoping someday they go away on their own.
That's awesome. That's awesome. So I know it looks like when we first started the process, you had about $1,000 of as far as surplus, but it didn't feel like a surplus because you still had stuff, that you had to pay for at the time that would just kind of soak it up. And I think, correct me if I'm wrong, Jennifer, I think you were with the credit card, you had this kind of cycle going of paying the card down, but still using the card, or I'm probably not saying it correctly. I'll let you explain it, but I know you had something going on with this credit card that, you ended up having to pay out a lot of money all the time.
I mean, we always paid the credit card off. But we would often just I would just switch credit cards and just play the credit card game of like, okay, well, that one's not due until the 28th of the month. I can take it up to this amount until then, and then I know somebody gets paid and I can pay it off, and then the next one. So there was just no planning. I mean, we still use credit cards mostly because we get a lot of benefit from them.
Right.
But I just monitor everything that's going on them constantly. And there's never a moment now where I'm like, we don't have the money in the account. Let me pull from savings to pay it off, or from a line of credit. We haven't touched the line of credit since we've been working with you.
Yeah,
I mean, it's there.
She said now I feel
like it's there. If I had like $90,000 I had to shuck out, I might have to tap into it, but
right. Yeah.
Not being tapped into at all.
Yeah. So y'all have gone from 1,000 surplus to like $5,000 surplus. Like, that is amazing, and people need to know what's possible. This is still a very short period of time, but you have positioned yourself to where you freed up the money and placed yourself in a different position to where now y'all have good problems. Like now it's getting used to having more money. And that has been an adjustment for you too. Like I mentioned earlier when we were talking about living paycheck to paycheck and kind of getting out of that mindset of I get paid Friday, but really thinking bigger. What about year to year? What about decade to decade? This year we're going to get $144,000 hypothetical that's coming into our house, that's hitting our bank account. How do we want to account for that money for the year? What do we want to say we accomplished for the year? Sometimes we have to give ourselves permission to think beyond just 2 weeks from now. Let's think about a month from now. What about a quarter from now? What about the year? And so now that you all are in this space, how difficult has that been? Just getting used to it's okay. We actually can, we have money now. We can plan to do things. It's okay.
Right. Yeah, that's been, I still can't get my head around that. I think I'm starting to, I was able to say, okay, we have so much money right now. Let me see where I can put it to grow it, which was just a whole new way of thinking. And it just was shocking to me. And we did have an emergency come up in July and we had to shuck out money right away. And I thought, oh my gosh, I don't have to worry about that, how we're going to pay for that. And I just, I would have just suffered and not done it before. And we're still learning. Okay, we know we like to vacation. We know we like to take our trips. We don't always budget for that. We don't always plan for that. I'd like to get to a point where I could plan to buy another house, like we might retire in, but we're still living. And, to be able to think like that is just really hard to get used to.
Yeah, I think if I could sum it up real quick, it would be we were definitely in the domain of reactive management before we met you. And we're now crossing into and moving forward farther into the domain of proactive management.
Mm-hmm.
And it's, really been kind of quite a major life change.
Mm-hmm. Mm-hmm. Absolutely. Absolutely. That's some life-changing stuff in a very short period of time. And I hope that people are really listening and grasping what you're saying about, like I said, what's possible. Like just this week, I know we had our meeting this week, and you were a little hesitant. Jennifer was a little hesitant to say that she took some money from savings and put it in a CD. Like it was a little scary. Like I don't know if that
Right.
was a good move. Was it
Right.
okay? Like,
Yeah.
and I'm like, yeah, that was good. That was good.
Yeah.
But it's just different, making those type of choices when you now have a bigger pot to make a choice from.
Mm-hmm.
And so it's going to continue to be that way. The more, the more you're saving and the more you're increasing your cash flow. And, now that you're in the position you're in, like you said, you were able to, even though you are still working on getting the travel all planned a little bit early and, the travel savings and that type of thing, you were still able to pay for all your travel,
Right.
from
Right.
the surplus. You don't have, you're not like other people that have had to put the travel on a credit card. They're taking months and months and months to pay it off,
Right.
and we're not talking about, down the street to North Carolina. We're talking about, international trips, of
Right.
quality level that, you've had to pay for. So, that I'm sure that had to feel really good, including
Yes.
upcoming trips you have and that type of thing. Like that should feel really good to know that you have the cash on hand to travel the way you want, but this is what it's all about: financial freedom. That's really the bottom line. It's what people want: the ability to do what I want when I want, within reason. If we want to be able to, obviously there's other stuff like we got to work that
Yes.
gets in the way, but in general, if we've done what we're supposed to do work wise and we have the time available, people want to be able to travel or to do the things that they love to do. Fly fishing. Did I say it right?
Yes, ma'am. Yep.
Fly fishing. Andrew likes to fly fish. And before, I know that before that was a little tight trying to make that happen
It
sometimes.
was.
Right.
Yeah.
Yeah.
The set of gear can be like a couple $1,000. And certainly before we met you, the thought of me spending a couple $1,000 on that was just kind of absurd. But so back in the spring, basically budget, Jennifer and I talked and we're like, okay, here's kind of the time frame when you can do it. So I had it all planned out, and when the money that we had allocated was there for it, I went ahead and got it. Yeah. So now it's pretty nice.
And I think also now that we feel better about it, having it under control and have a better understanding it, I now feel like I can start to teach my kids, right? So that's a huge part, just kind of passing that on to them.
Absolutely. Absolutely. We always want better for our kids, but we got to really define that. What does that mean exactly? Better for our kids? Do we want them to just we want to provide for them better, or we want them to be able to provide for themselves better? And so part of that is teaching them and laying those financial principles, creating that foundation, planting those seeds so that they're not, our age trying to still figure it out. They've already gotten it together in their 20s, and they'll be better for it. And those are the things that they're going to remember way more than just, mom bought me a shirt and some pants, or my favorite watch, you know what I mean? So I think all of that is really, really wonderful. I had one last question before we go, and I've forgotten now what it was. So Andrew, I remember in our meeting the other day, I think, my question was, do you feel, I know you had some hesitation about being okay before with spending on yourself. Do you feel like you can kind of let go a little bit, and give yourself permission, if you will, to, enjoy a little bit more because you can?
Yeah, that's a good question. So the short answer is yes. I would say that, kind of pre Breanna, with that kind of paper route mentality I had, I couldn't bring myself to look at it from that perspective. But now, you help me to kind of see the numbers, and I think a key thing has been cultivating habits in us, that financial habits, that have, if you want to break kind of an old pattern, you have to have new habits. And you kind of introduced us to those habits, eased us into them, and kind of guided us along the way. And one of those habits is me thinking about and moving forward on a plan to get a $2,000 fly rod, with proper planning and all that. So yeah, definitely the thought of doing something fun for myself that isn't absolutely necessary wasn't thinkable before. But yeah, I'm definitely and yeah, it's a good kind of place to be, I guess.
Yes, absolutely. Absolutely. Well, thank you guys so much for taking the time today to hang out with me and talk a little bit about your journey. Again, I'm so very proud of where you guys are. And I know we still, have more to go because, you just said you want to buy another house and we want to do this and that, the goals get bigger and bigger and bigger. I love it. I love it. But you're just speaking to the point that anything that people want is possible with the right plan. You just got to plan and execute. That's really the bottom line. They have the discipline to follow the plan, and anything is possible. Anything is possible. So with that, everybody have a wonderful day, and we'll see you next time. Bye-bye.
Thanks.